Okay, for the very last section of Chapter 2, we're going to talk about financial statements that you would prepare after you're done recording transactions for the month. And there's always 3 statements that you prepare at the end of every month. The managers in your business are usually eager to get, so as quickly as you can get them prepared at the end of the month, that's better. They're the income statement, the statement of owner's equity, and the balance sheet. And the way I have students remember which order they go in. Remember back in the day when you owed somebody money, you would make an IOU, sign a little piece of paper that said I owe you some money. Well, I have my students remember it like this. There's 3 statements, and instead of IOU, we're going to just learn IOB. The first one is the income statement. The second one is the statement of owner's equity, O for owner's equity, and the third one is the balance sheet. And basically, the income statement shows the results of a business operation for a specific period of time. The income statement shows the revenue that was earned and the expenses that were incurred for doing business. And the difference between the revenue and expense is the net income or the net loss of a business. If revenue and expenses are equal, the company is said to break even, which I've never known one to do. When you prepare an income statement, basically you have a section for revenues, and you can look on the top of page 35 in your textbook if you want to take a look at one. You'll have a section for revenues, and you'll list all your revenue accounts. And really for the first 6 chapters of this book, we're going to use fees income as our revenue account. It's the name of the account where we record any fees we generate from our customers. And then you'll make a section for expenses, and you'll list every single expense account that you have, and you'll add them up, and you'll take the revenues minus the expenses. If revenues are more than expenses, you'll have a net income. If expenses are more than revenues, obviously you'll have a net loss. And the first 3 lines of an income statement tell who, like the name of your business, what kind of statement it is, like income statement, and for what period of time it covers. And usually we just use month ended, December 31, 2012, or quarter ended September 30, 2012, or 6 months ended. It always shows the period of time. The second statement that you'll look at is the statement of owner's equity. And the statement of owner's equity reports changes in the owner's financial interest during the reporting period. And this is prepared before the balance sheet in order to know the ending capital balance to include on the balance sheet. And there's 4 things that affect the owner's equity. Whether you have a net income, that'll increase the owner's equity. If the owner has added some more money or other assets into the business, that'll increase owner's equity. Or you'll have a net loss, and that'll decrease owner's equity, or any withdrawals that the owner makes. That withdrawals decrease owner's equity if the owner takes money out of the business. And again, if you prepare a statement of owner's equity, it'll look like the picture on the top of page 36 in your textbook. And the 3 lines at the top always tell the name of the company, what kind of statement it is, and what period of time it covers. And the third statement you'll prepare is a balance sheet. There's a picture of one at the top of page 37. A balance sheet shows assets, liabilities, and owner's equity on a given date. The 3-line heading at the top again tells who, the name of your company, what kind of statement it is, it's a balance sheet, and just the date that those balances represent. Balance sheets prepared using the account form show total assets on the same horizontal line as total liabilities and owner's equity. And you can see in the picture above, that's the account form. So the assets are on the left and liabilities and owner's equity on the right, similar to the fundamental accounting equation, assets equal liability plus owner's equity. So those are the three statements you'll prepare, and if you look at the picture on page 37, those three pictures at the bottom, you'll see that on the income statement, the net income amount figures into the change in the statement of owner's equity, and then the new owner's capital account on the statement of owner's equity feeds into the new capital account balance on the balance sheet. So each of the three statements ties together and gives a good picture of the transactions, that what's happened in your business over a period of time. All right, that concludes Chapter 2.